The forest never rushes the seasons. Winter never begs for spring. And the strongest trees do not grow because they are impatient. They grow because they endure time. Markets behave the same way. But people rarely understand this. I have watched investors for decades. Brilliant minds, educated people, people with access to more information than any generation before them. And yet the same mistake repeats again and again. They want the reward before they have survived the cycle. They want validation before patience has finished its quiet work. And the market has a way of punishing that kind of impatience. A market cycle is not just a movement of prices. It is a mirror held up to human nature. Greed rises when prices rise, fear appears when prices fall. And discipline, the rarest quality of all, is tested in both directions. I learned this slowly, not from books, but from years of sitting quietly while others rushed. The market has seasons, just like the forest. There are seasons of easy growth, seasons when everything seems to work. Then there are winters, long, quiet, uncomfortable winters. Most people cannot tolerate those winters. They panic. They abandon their positions. They question their strategy. But the patient investor, the quiet one, the one who understands cycles, he waits. Because patience is not passive. It is strategic silence. There is a strange illusion in investing. People believe success belongs to the smartest person in the room. In reality, it often belongs to the calmest. The one who is not desperate to prove anything. The one who can sit with uncertainty without announcing every move. Over time, I came to see wealth as something very different from what most people imagine. Wealth is not a race, it is an invisible game. And like all games played quietly, the loud players rarely win. I have seen men announce their success too early. They display their profits, they speak proudly about their trades. They reveal their strategies. And almost immediately something begins to shift around them. Attention appears, questions appear, and eventually, envy appears. Human nature is predictable in that way. When someone sees another person gaining advantage, something inside them begins to resist it. Not always consciously, often quietly. But envy has a strange gravity. It pulls against progress. I learned long ago that silence protects progress. This idea became a philosophy I follow to this day. I call it the silent cycle. The silent cycle is the understanding that wealth compounds best in the dark. Just as seeds grow underground before they break the surface, capital grows best when no one is watching. The moment wealth becomes visible, pressure begins to form. Social pressure, psychological pressure, expectation. And expectation is a dangerous companion in the market. I made a rule early in my life. I never reveal my net worth, not to acquaintances, not to distant family, not even to people who believe they deserve to know. Because the moment a number is attached to your identity, something changes in the way people see you. Some admire you, some resent you. But very few treat you the same way again. And both admiration and resentment create distractions. The market rewards focus, not attention. I once watched a man become extremely successful in a short period of time. He was talented, disciplined, patient. For years, he operated quietly. Then success arrived, and with it came recognition, interviews, articles, public conversations. Suddenly, everyone wanted to hear his thoughts, and slowly, almost invisibly, his behavior changed. He began explaining his positions before they were fully formed. He announced ideas too early. He became invested in defending his opinions publicly. Within 3 years, the discipline that built his success had eroded. The market did not destroy him. Attention did. There is another rule I keep. I never announce my next move. In the forest, the predator that announces its path goes hungry. The quiet one survives. Markets are similar. The moment you speak too openly about future decisions, you create pressure to follow through, even when conditions change. And the market is constantly changing. Flexibility requires privacy. Silence allows adaptation. But people crave validation. They want to be seen making the right decision. So they reveal plans prematurely. They discuss investments publicly. They seek agreement. Agreement feels good, but it weakens independent thinking. Some of my best decisions looked strange in the beginning. If I had needed approval, I would never have made them. Information is leverage, and leverage loses its power when it is shared too freely. I never share the true source of my investing edge, not because I am secretive by nature, but because advantage disappears once it becomes common knowledge. A fisherman does not tell the entire village where the fish gather, not because he is selfish, but because the water cannot feed everyone at the same time. Markets behave the same way. Edges are fragile. Once too many people adopt the same strategy, the advantage disappears. I have seen brilliant strategies collapse simply because they became popular. Success attracts imitation, and imitation destroys scarcity. Scarcity is what gives strategy its power. There is another quiet mistake I have watched wealthy families make. They promise too much to the next generation. They guarantee inheritance. They remove uncertainty. And in doing so, they remove the incentive to build strength. A tree that grows in constant shelter develops weak roots. The first real storm breaks it. Children are not protected by guaranteed wealth. They are protected by learning to survive cycles themselves. I never poison the next generation with promises. Opportunity is valuable. But comfort without effort slowly erodes character. I have seen fortunes disappear within a single generation because discipline was replaced by entitlement. Wealth requires patience, but more importantly, it requires respect for effort, and effort must be experienced personally. Another principle I follow is rarely understood. I never broadcast charity, not because generosity should be hidden, but because public generosity changes its nature. The moment charity becomes visible, it invites applause, and applause subtly transforms kindness into performance. Quiet generosity preserves intention. There is a deeper reason for silence in these matters. Attention distorts behavior. When people know they are being observed, they begin acting for the audience rather than for the principle. The same thing happens in markets. Traders who perform publicly begin trading for reputation rather than results. That is a dangerous shift. Reputation is a fragile currency. Markets do not reward reputation. They reward patience. The longer I have watched cycles unfold, the more obvious one truth becomes. The loudest investors rarely last the longest. They are too busy explaining, too busy proving, too busy defending their image. Meanwhile, the quiet investors continue compounding, slowly, patiently, almost invisibly. Market cycles test temperament more than intelligence. When prices rise rapidly, discipline whispers caution. But ego prefers celebration. When markets fall sharply, discipline whispers patience, but fear demands action. The patient investor listens to the quiet voice, not the loud one. There were years when doing nothing was the most profitable decision available. That is difficult for many people to accept. Action feels productive. Stillness feels irresponsible. But cycles reward restraint. A hunter who fires every time he hears a sound quickly runs out of ammunition. The patient hunter waits. Markets reward the same patience. Opportunities appear, disappear, and eventually return. Those who survive the quiet periods are the ones prepared when the next cycle begins. Time filters out impatience. That is why markets eventually reward patience, not because patience is magical, but because impatience eliminates competitors. Every panic sale removes someone from the game. Every emotional decision weakens someone's position, and the patient investor simply remains. I have learned that wealth does not grow through excitement. It grows through endurance. The ability to remain calm when others rush. The ability to remain silent when others announce. The ability to remain patient when others demand results. These qualities are not dramatic. They are quiet, almost invisible. But over time, they compound just like capital. Years pass. Cycles repeat. And those who mastered patience begin to see something remarkable. While others restart their journey again and again, they simply continue. Progress becomes smooth, steady, uninterrupted. This is why patience is rewarded by cycles, because cycles remove those who lack it. The forest does not grow in a single season. It grows through many winters, and the strongest trees are the ones that survive the quiet years. I have watched markets long enough to know one thing with certainty. Time reveals character, and character determines survival. Those who chase attention eventually lose focus. Those who seek validation eventually lose independence. Those who reveal too much eventually lose advantage. But the quiet investor, the patient observer, the one who understands cycles, he grows stronger every year because silence protects strategy, patience protects capital, and time rewards both. In the end, the market does not reward speed, it rewards endurance, and endurance prefers silence.